Hey guys, what's up? I'm Erin and welcome back to the channel. Over the past week or two, there were changes made to the upfront mortgage fees that went into effect on May 1st. And to say that these changes caused a little bit of controversy might be an understatement.
Federal rule on mortgage rates kicks in tomorrow, and it may have you paying more if you have a high credit score.
These rules punish borrowers with higher credit scores.
Is rolling out a new plan that punishes people who have good credit.
Officials from 27 states now, they're pushing back against the administration's new mortgage rule. They call this rule a disaster.
It's important to note that these changes affect the upfront fees you face when you take out a mortgage, not the ongoing interest rate, which is really more critical to determining your regular monthly payment. What's making headlines is that under the new framework, those with higher credit scores are now going to face higher upfront fees than they previously would have under the old framework. Meanwhile, those with comparatively lower credit scores are now going to face less fees under the new framework than they would have under the old framework. Perhaps we even saw headlines saying those with the highest credit scores are now going to pay more than those with lower credit scores, but that's not true. Yes, this rule did affect the fee structure, and now those with lower credit scores are going to pay less in fees than they otherwise would have, and those with higher credit scores are going to pay more than they otherwise would have. But still, the highest absolute fees go to those with the lowest credit scores, and the lowest fees still go to those with the highest credit scores. A person's credit score is one of the most important indicators of credit worthiness to lenders, helping to determine if a prospective borrower will qualify for a loan and what interest rate will apply. Now it's just that those with lower credit scores aren't being penalized as harshly, and those with higher credit scores aren't getting as much of a break. All in all, it went into effect on May 1st, this new schedule of upfront fees, and it applies to mortgages backed by Fannie Mae and Freddie Mac. The new fees will increase costs to borrowers overall by 0.04 percentage point, according to the Federal Housing Finance Agency, FHFA. That means a borrower who would have paid a 6.5% APR under the old fees will now pay a 6.54%. Let's look at an example to see how this rule change will affect fees. According to a recent analysis from Bankrate, someone with a below average credit score of 640 seeking a $350,000 mortgage with a 20% down payment paid $10,500 in fees before the new regulations. They will now pay $7,875. Someone with a 740 credit score exploring the same deal paid $1,750 in fees before the FHFA's new rules, but now is expected to pay $3,062. And it's easy to see why these changes are upsetting to so many people. You work really hard, you're responsible with your finances. Why should you now have to pay more? Meanwhile, those who aren't taking those steps are getting a break. It's an idea of fairness. It's really the responsible people who have done the right thing, who've kept their credit in check, they're being hit with yet another fee. And listen, I don't like facing higher fees any more than the next person, so I get this argument. But I also think it's hard to have the foundation of an argument come down to fairness. I think there's a lot of things that happen in life, especially at the federal level, that aren't fair. The truly important point to focus on is that if you have a higher credit score, you're going to face lesser fees and a lower interest rate. And if you have a lower credit score, you're going to face higher fees and a higher interest rate. Higher credit score borrowers are not being charged more so that lower credit score borrowers can pay less. The updated fees, as was true of the prior fees, generally increase as credit score decreases for any given level of down payment. So why are these changes being made? The government says these changes are being made in an effort to make housing more affordable to those who are otherwise limited by income or wealth. But if you dig a little deeper, the Federal Housing Finance Agency does expand on this, saying that this change will better protect taxpayers in the long term and put the enterprises on more durable footing, which will allow them to support affordable, sustainable mortgage credit across the economic cycles to benefit all Americans. And they will do so with a pricing framework that is more accurately aligned to the expected financial performance and risks of the loans they back. If I'm being honest, I don't actually think that's the reason for the change in the fees. Here's my 2 cents for what it's worth. Take it or leave it, agree, disagree, be neutral. Leave your thoughts in a comment down below. Over the years, consumers as a whole have actually improved their credit scores. Just 10 years ago, the average credit score of all consumers was about 680. And now it's 716, which is great. As a person who loves seeing when people are making good choices with their finances, I love seeing this improvement. And one of the biggest things people do when they're getting ready to take out a mortgage is work on improving their credit score. So when they actually do take on that mortgage, they get the very best interest rate. And it shows. Because according to the Federal Reserve, the median credit score in the US for those taking out a mortgage is 768. Even with what is typically the youngest home buying group, first-time home buyers, they've made great strides in improving their credit scores before taking out a mortgage. The average credit score for a first-time home buyer is 746. So it seems to be those who are taking on mortgages tend to be those with the better credit scores. When it comes to a conventional loan, you generally need to have a credit score of at least 620 in order to get approved. But as more and more consumers improve their overall credit score, those with the highest credit scores end up being the ones applying for mortgages to buy homes. It is these very top groups who end up getting the mortgages. And under the old rules, it was these very top groups who ended up facing the biggest break in fees. So I think it all comes down to revenue. I think the government's trying to boost its bottom line. If more and more consumers are going to focus on having good and great credit scores, under the old fee structure, that hurts the government's revenue streams. So they're trying to find a way to boost profits. And they have to target this group because that's their biggest customer base. I personally don't think it has anything to do with trying to make housing more affordable. I think that's putting a spin on things. I really think it all comes down to revenue. If we really wanted to discuss the affordability of housing, I don't think the crux of the matter is an extra $1,000 or $2,000 in upfront costs. I think we'd actually have to discuss the actual price tag of a home or incomes, but let me know your thoughts. So if anybody was out there thinking, well, after these new rules, obviously my credit score just must not even matter anymore, that is absolutely not the case. That's not true. Your credit score remains one of the most important determining factors in what your interest rate will be and what kind of fees you will face. Just as it was in the past, it remains true today. For those with the highest credit scores, they will face the lowest fees, and those with the lowest credit scores, they will face the highest fees. Who's affected? That's the big question. That's what we all care about. The new fee structure was developed by the Federal Housing Finance Agency, and that agency oversees Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac, two government-sponsored enterprises, buy about 2/3 of the mortgages originated by U.S. lenders. So really it is most home buyers who are going to be impacted, especially considering that these are conventional loans, those that target the general population. Those loans that are not affected are going to be those that are FHA loans, VA loans, or USDA loans. New brackets have also been added to the fee structure. Prior to this change, home buyers with credit scores of 740 on up face the same fee structure. However, now there will be varying fees for those with scores 750 to 759, 760 to 779, and 780 on up. All the more incentive to get your credit score to the excellent range rather than just aiming for the good range. And then really those with the lowest credit scores, they're not being penalized as harshly. Other items not really making headlines is that it could become more expensive to refinance your home, as previously the highest cash out refinancing sat at 2.125%, but now for some borrowers could go all the way up to 5%. But if you're in the market for a multi-unit property, you would now actually face lesser fees, as previously fees sat at 1% across the board. Now they're in a lower range. At the end of the day, there's not a lot you can do at the individual level to influence what's happening at the federal level. These fees kind of are what they are. With that said, you do have a lot of control over your life at the individual level. So what are the best things you can do if you're looking to buy a home and you're in need of a mortgage? 1, build up that credit score. Aim to get it in the high 700s or even all the way into the 800s. And 2, save up a good down payment. Because with a high credit score and a hefty down payment, you're going to be entitled to the lowest interest rates and the lowest fees. So don't forget to let me know your thoughts in a comment down below. I know this one is a controversial topic, so I'm curious to hear what you have to say. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye.